Section 3.2 Understanding Dividend Payout Ratio, Cash Flow and Retained Earnings. Cash flow generation and retained earnings are closely linked to a company's dividend payout ratio. They play a significant role in determining the amount of earnings that can be allocated to dividends. Here's an analysis of how cash flow generation and retained earnings influence the dividend payout ratio. Cash flow generation. Cash flow generation is a crucial factor in assessing a company's ability to sustain and increase dividend payments. Cash flow represents the actual cash inflows and outflows generated by a company's operations, investments, and financing activities. There are two primary types of cash flow that impact the dividend payout ratio. Operating cash flow. Operating cash flow measures the cash generated from a company's core business operations. It reflects the cash generated by sales, the collection of accounts receivable, and the payment of accounts payable and other operating expenses. Higher operating cash flow provides a stronger foundation for dividend payments, as it indicates the company's ability to generate cash from its day-to-day operations. Free cash flow. Free cash flow represents the cash generated by a company after deducting capital expenditures, investment in property, plant, and equipment, from operating cash flow. Free cash flow is important for dividends because it represents the cash available for distribution to shareholders after accounting for necessary investments to maintain or expand the company's operations. A higher level of free cash flow allows a company to have more resources available for dividends. Retained earnings. Retained earnings are the portion of earnings that a company chooses to retain and reinvest back into the business rather than distributing as dividends. Retained earnings accumulate over time and contribute to a company's financial strength and growth potential. They have a direct impact on the dividend payout ratio in the following ways. Impact on dividend availability. The amount of retained earnings affects the funds available for dividend payments. A company with higher retained earnings has a larger pool of earnings that can be allocated to dividends, potentially leading to a higher dividend payout ratio. Reinvestment for growth. Retained earnings are often reinvested in the company's operations, such as funding research and development, acquiring new assets, expanding facilities, or pursuing strategic initiatives. When a company retains a larger portion of earnings for growth, it typically results in a lower dividend payout ratio as fewer earnings are distributed. Financial health and stability. Retained earnings contribute to a company's financial health and stability. By retaining a portion of earnings, a company can strengthen its balance sheet, reduce debt, build cash reserves, and create a cushion for economic downturns or unexpected expenses. This financial stability supports the company's ability to maintain consistent dividend payments. Balancing dividends, cash flow, and retained earnings. Companies need to strike a balance between distributing earnings as dividends and retaining earnings for future growth and financial stability. The dividend payout ratio reflects this balance. A company with strong cash flow generation, sufficient free cash flow, and healthy retained earnings is better positioned to sustain and potentially increase its dividend payout ratio. However, it's important to note that excessive reliance on dividends without adequate cash flow generation or retained earnings can strain a company's financial resources and limit its ability to fund growth initiatives. Companies must consider their capital requirements, growth prospects, industry dynamics, and investor expectations when determining the optimal dividend payout ratio that aligns with their long-term strategy. In conclusion, cash flow generation and retained earnings significantly influence a company's dividend payout ratio. Robust cash flow generation provides the necessary funds for dividend payments, while retained earnings impact the availability of earnings for distribution. Companies that strike a balance between dividends, cash flow, and retained earnings are better positioned to maintain sustainable dividend policies and support future growth. Sufficient cash flow is crucial to support dividend payments for several reasons. The availability of cash is essential to meet the financial obligations associated with paying dividends to shareholders. Here are the key reasons why sufficient cash flow is important to support dividend payments. Meeting regular dividend obligations. Companies that declare regular dividend payments are expected to fulfill those obligations consistently. Shareholders rely on receiving their expected dividend income, especially if they invest in dividend-paying stocks for income purposes. Sufficient cash flow ensures that a company can meet its dividend payment obligations on time, maintaining the trust and confidence of its shareholders, demonstrating financial stability. Dividend payments are often seen as a sign of financial stability and strength. Companies that consistently generate sufficient cash flow to support dividend payments demonstrate their ability to generate sustainable profits and maintain a healthy financial position. This stability can enhance the company's reputation, attract investors, and potentially lead to a higher valuation in the market. Retaining investor confidence. Dividend payments are a tangible way for companies to share their success with shareholders. Regular and reliable dividend payments create a positive perception among investors, indicating that the company is committed to rewarding shareholders. Consistently providing dividends supported by sufficient cash flow can help maintain and strengthen investor confidence in the company's ability to generate long-term returns. Fulfilling legal and regulatory requirements. Certain jurisdictions have legal and regulatory requirements regarding dividend payments. For example, some countries require companies to pay dividends out of their accumulated profits or have specific rules governing dividend distributions. Adequate cash flow ensures compliance with these obligations, avoiding potential penalties or legal issues. Managing investor expectations. Companies that have established a dividend policy and have a history of paying dividends at a certain level create expectations among investors. If a company fails to meet these expectations due to insufficient cash flow, it can result in disappointment and may negatively impact the company's stock price and investor sentiment. Flexibility for dividend increases. Sufficient cash flow not only supports the existing dividend payment level but also provides flexibility for potential dividend increases. Companies with healthy cash flow can consider raising dividend payouts when they experience strong earnings growth or have excess cash reserves. This can be an attractive proposition for investors and may contribute to the company's long-term shareholder value. Weathering economic downturns. During economic downturns or challenging business environments, companies with sufficient cash flow are better positioned to maintain dividend payments. They have the financial resources to navigate through periods of reduced profitability or temporary setbacks without cutting or suspending dividends. This can help retain investor confidence and mitigate potential negative impacts on the company's stock price. In summary, sufficient cash flow is essential to support dividend payments. It ensures that a company can meet its dividend obligations, demonstrates financial stability, retains investor confidence, fulfills legal requirements, manages investor expectations, provides flexibility for potential dividend increases, and enables resilience during economic downturns. Investors often consider a company's cash flow generation and its ability to sustain dividend payments as critical factors when evaluating the attractiveness and reliability of dividend-paying stocks.